or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
If I could follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. you see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. You know what, let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you've got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? You know, that's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies, and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minorities, unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix?
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
we're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate, and I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates.
Thank you.
Thanks very much.
That wraps up the news conference with Chairman Powell down in Washington, D.C. Here in New York City, we're reacting to a 25 basis point rate cut from the Federal Reserve, a dissent pushing for 50 basis points, and a huge debate about the future. Anna Wong of Bloomberg Economics with this to say: I have not seen a meeting with so many contradictions. This is a low-conviction Federal Reserve with limited visibility and a very wide range of views on the future. And this is why this market is so confused, captured by this move in the equity market on the S&P 500. Move lower, move higher, all over the place. This market is somewhat shaken. Bramo, this Federal Reserve has no idea what 2026 is going to bring, and this chairman did his best to articulate that.
And I don't know that he sent a clear message, because it's not possible to send a clear message. That sound you hear, that's the idea of forward guidance dying. Because ultimately, how can a Federal Reserve with this level of dispersion in views really give any sense of their reaction function? And to me, the idea that he said there wasn't widespread support at all for a 50 basis point rate cut, and talking about this as a risk management rate cut, flew in the face of the hopes and dreams of markets that were hoping for a bit more.
And that's brilliant about forward guidance just evaporating. And John, it goes back to when you looked into the other room here, the south wing of our studios, and you looked at the dot plot, and the dispersion looked like a B-52 bomber's wingspan.
Massive spread.
Massive.
We can talk about it right now, TK. At the very bottom of that spread is a dot that's basically projecting a massive amount of rate cuts for the year.
It's a political dot.
A sub 3% dot. Tom, look above it. You've also got a dot there that's looking for a Federal Reserve that could be hiking interest rates over the next several meetings. These dots are all over the place, and Bramo, you nailed it. A risk management rate cut, two-sided risk, no risk-free path, in a meeting-by-meeting situation. I think the chairman did his best here to form a consensus that probably didn't exist on the committee when they got together for the first day just yesterday.
Yeah, I think that that's well said. He even talked about the labor market, that clearly you can no longer say it's very solid, but then he went on to say that any kind of headline disappointment was due to the immigration picture, probably in a significant part. This is the reason why it is a Federal Reserve that is unable to really present forward guidance, because ultimately we don't even know who will be doing the guiding, who will be doing the decision-making come next year. And that is the reason why there's so many questions about that outlier. Tom called it a political dot. That political dot potentially has quite a bit of weight.
It might be a flavour of things to come in 26 and beyond. Joining us now to discuss, the former New York Fed President, Bill Dudley. Bill, welcome to the programme, sir. A lot to process here, many contradictions. Is that a fair way of describing this meeting?
I think there's a lot of tension between the inflation outlook and the labor market outlook, but I think Powell said it pretty well. I mean, he said basically we think that the risks on the unemployment side have risen more than the risks on the inflation side. And so given that, we should be less restrictive. And so we're taking out essentially a risk management cut to reflect the fact that the risks on the labor market seem to be a little bit higher. After that, there's a lot of uncertainty about, how that's going to evolve in 2026 and 2027, and the committee, is split about what to do going forward. I think it's interesting. The market reaction initially was like, "Oh, gee, 2 more rate cuts this year," and then I think people parsed the summary of economic projections a little bit more and realized that it was actually 9 to 9 plus Murrin. So 9 people wanted either no more cuts or 1 more cut, and 9 wanted 2 more cuts, and then there was Steve Murrin, who I'm absolutely confident that's his dot.
Well, Bill, I think a lot of people would agree with you. I just wonder going forward how much you were satisfied by Fed Chair Powell's response to why they're upgrading their expectation for inflation, why they always put the idea of 2% 2 years out, and why they are still cutting even though they have not achieved that in more than 5 years.
Well, if he didn't think policy was restrictive today, then they certainly wouldn't have cut. But he's starting with the premise that policy is restrictive, it's exerting downward restraint on the economy, and basically, given that the balance of the risk have shifted towards greater risks to the downside on the labor market side, he wants policy to be somewhat less restrictive. So this is a very modest adjustment, and I don't think there's a lot of, I don't think there's forward guidance at this point really that's meaningful, because it really is going to depend on how the market. The economy evolves. I mean, look at the data just over the last couple of months. We have weakness in the labor market, and then we seem to have strength in terms of GDP and spending. So the Atlanta Fed GDP now forecast for the third quarter is at 3.4%. So there's a lot of uncertainty on the outlook. But this is an insurance rate cut. That's all it is, and it doesn't really foreshadow what's going to happen going forward.
Bill Dudley, you're one of our best at dovetailing the dynamics of market economics into our academics. I think of Robert Hall, who was at Berkeley, and he went over to a school across the bay. I can't remember the name of it right now. Bill, I look at the inflation. Let's take East Hampton, Massachusetts, where when you were a kid, you were in school there. Sewage rates are up 33% in the last 24 months. Is this a Fed looking at a purchasing power crisis for too many Americans out to the December 10th meeting and into next year?
Well, there's definitely a squeeze on low-income households. They don't benefit by the rise in the stock market. They don't benefit by the fact that they're locked. They hold 3% mortgages. They're hurt by the higher tariffs. They're hurt by the weaker labor market, and so it's really a tale of two economies in terms of the outlook. Monetary policy is a very blunt instrument, and unfortunately, the Fed can't calibrate monetary policy to sort of equally help everybody in the current environment.
So who do they do it for, John? Global Wall Street? Is that the mandate?
I was thinking back to, TK, my days back at school when I was a kid. If I kept telling my mum, in 2 years I'll do better, in 2 years I'll do better, I'm sure my mum at some point would lose patience. Bill, should we lose patience with this Federal Reserve? What is this? In 2 years' time, we'll hit our inflation target. In 2 years' time, we'll hit our inflation target. Mike McKee addressed this in the news conference, and I actually think it's a really important moment. How credible is this pursuit of 2%?
Well, I think it's a fair point that every it's always 2 years later we're going to finally achieve our inflation objective. The Fed's basically trying to, as Chair Powell made it very clear, they're trying to balance the fact that the two goals are in tension. And so if they just focused on driving immediately to the 2% inflation goal, that would lead to much higher unemployment. And so they want to balance those two risks. But, the risk to the Fed is that every year you continue to go with inflation above 2%. The risk is that inflation expectations finally become unanchored. And the attacks on the Fed's independence obviously increase that risk.
Bill Dudley with the latest. Thank you, sir. Appreciate your reaction. Thanks for standing by. The former New York Fed president, Mike McKee, was in that news conference. It was an important moment, I think, and Mike McKee joins us now for more. Mike, first of all, your assessment of the last 60 minutes or so, and what did you make of that exchange you had with the Fed chair?
Well, in the last 60 minutes or so, I think Jay Powell was trying to walk a very fine line because he's got a very divided committee. Nobody is sure what's going to happen going forward except for Stephen Myron, who thinks that things are going to be absolutely rosy and we need to cut rates a lot. Everyone else is uncertain, and the dot plot median shows 2 rate cuts this year, but when you look at the dot plot itself, it's so narrowly divided that you really can't take any signal from it, as Bill Dudley was saying. So Powell is trying to tell people that we really don't know without saying we really don't know. And as Bill said, trying to make this an insurance cut. The 2% thing, I think, is a real question for them. And he didn't really give a good answer to my question. It's not just that, that inflation expectations become unanchored, but that higher expectations can become embedded. And people don't think you're going to get it down farther. And so then how do you fight that going forward if you can't make any progress or can't be seen to be making any progress towards your target?
Mike, while you're down there, since you are in the room, it sounded like Fed press.
जब एफएनओ ट्रेडिंग की बात हो तो you need a platform that is made for trade. And on Dhan, we have awesome features like OI profile for deep understanding of market sentiments, advanced option chain for smarter strategy planning, and super orders for setting entry, target, stop loss in just one go. And you can do all of this on the same FNO trading platform. So what are you waiting for? Download the Dhan app today.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.
ब्रेकिंग न्यूज मिंत्रा बीएफएफ सेल पे है ट्रिपल डिस्काउंट तो सिर्फ देखो मत विश लिस्ट करो
Pretty much as they usually do. The Fed's statement wasn't that unusual. There obviously was the big elephant in the room of Stephen Myron that the chairman declined to comment on. He also declined to comment on Lisa Cook. He tried to keep it just to the Fed. So it really wasn't a hugely different dynamic, except that there were a lot more moving parts than we often see, or at least than we've seen in a number of years.
Mike, just before you go, there was a moment there where I do think he addressed the Governor Myron question, the importance of one individual on the committee and how much sway they have on the FOMC, how they've got to persuade the other individuals in the room. And Mike, I think it begs the question, if that Stephen Myron dot, that Governor Myron dot, sub 3% is a flavor of things to come, Mike, to what extent this committee will push back?
Well, clearly the committee pushed back today, and we didn't see a dissent from Mickey Bowman or Chris Waller. So they seem to be satisfied with where they are at the moment. And that suggests that Stephen Myron is not going to have a lot of influence. Nobody really expected him to. It does raise the question, though, John, as you sort of imply there, that if the president gets more people on the board, where do we go from here? And the Myron dot is a sign that the president's people would definitely try to push rates lower, whether or not the economy justifies it.
Mike McKee with the latest. Mike, a clinic as always. You're one of the very best. Appreciate your time. I think it would be a massive mistake just to say that's all political. We had this conversation with Greg Peters of PGIM right before the news conference. He said what's political and what's real. Whatever you think is political right now might be real next year. And that might be a flavour of what's still to come. from the incoming chairman for 2026. And it's not just about being able to persuade the rest of the committee. It's a question about how credible it will be with fixed income and broader markets.
And right now, it seems like it was credible to the extent that it's not causing some sort of massive sell-off in long-term yields. I do think it's notable that there was only one dissent about a 50 basis point rate cut, and I think we have to keep going back to that. But Stephen Myron was alone. He didn't get a sort of concurrent opinion from Mickey Bowman or Chris Waller.
We're going to get to Jeff Rosenberg, but John, I was going to go to Mike on this, so let me just bring it up. April 29 next year, June 17th next year, July 29. I think there's an election just after the October 28 meeting. When does House politics or even Senate politics come into this discussion with a vengeance? I don't know when it is.
I think we're right there right now.
Yeah.
You know, before this decision, Tom, we sat around the table and I said, this is the last set of forecasts you'll get from Chairman Powell without knowing who the incoming Fed chair is going to be. Yeah. And I think we can say that. By the time we get to December, we'll know who the Fed chair is. We expect to know who the Fed chair is. And you're also going to know what they think about where policy should be in